Hello students, welcome to my class. This is Professor Vincent Osaya, and this is the presentation of part 1 of chapter 21. Chapter 21, accounting for leases. Now, first of all, the chapter is divided into 4 sessions. Number 1, we are going to talk about the leasing environment. Number 2, we are going to talk about the accounting for leasing. Number 3, we're going to talk about the accounting for the lessor and some special lease accounting problems. So overall, we are going to talk about the accounting rules relative to lease or leases and how to apply those rules for the purpose of preparing financial statements in accordance with generally accepted accounting principles. So let's take a look at the first objective. We are going to talk about the nature, economic substance, and advantages of leasing transactions. The leasing environment. Here we have 2 parties here. Here we say it's a lease is a contractual agreement between a lessor and a lessee that gives the lessee the right to use specific property owned by the lessor for a specified period of time. So we have 2 parties here. In a very simplified manner, this is a situation whereby a company leases an office space from the landlord. The landlord is the lessor and the company is the lessee. So, but it gets a little bit more than that in terms of different leasing arrangements that companies get involved in. And here we are told that here are some industries that get involved heavily in leasing equipment and other tools that they use for their business. Information technology equipment, transportation, like aircraft, trucks, construction, agriculture, so on and so forth. Now, let's take a look at here are some well-known companies that get heavily involved in different leasing arrangements. Now, the question is, who are the players in terms of leasing arrangement? Who are the players? Now, here we are talking about the companies or industry that get involved in leasing. We know traditionally of the lessee and the lessor. Sometimes a third party gets involved. For example, the bank. The bank can make the fund available so that companies are able to lease their equipment to lessees. Now, we also have independent companies get involved, and we have also what we call captive leasing companies. For example, like Ford Motors, they have their credit arm, or they have a subsidiary that specifically engages in financing cars to individuals and businesses. So these are the players in the leasing environment. Moving along, the question is, what are the advantages of leasing? Here we have 6 different advantages. We are not going to go through all of them. Let's take a look at number 1, 100% financing at fixed rate. What are we talking about here? If you lease an equipment that you would have purchased for $250,000 from a company for 10 years, and that is basically how much time you need the equipment, indirectly the company that leases the equipment for you is indirectly financing the deal for you. In other words, you don't have to worry about going to the bank to go through the loan processing requirements in order to get that fund to lease the equipment. So one of the advantages is 100% financing at fixed rate because the lessor indirectly is financing it for you. Now let's take a look at the last example here, off-balance sheet financing. What does that mean? Listen to this carefully. You have 2 companies, Company A and Company B. The 2 companies are in the same industry, and both companies desire to buy a $500,000 equipment. Company A borrowed $500,000 to buy the equipment. On the balance sheet of Company A, they are going to report asset of $500,000 and a debt or liability for $500,000. if company B is able to lease the same equipment, guess what? The company B does not have to report the liability on its equipment, and thereby taking off the liability or the debt from this balance sheet. So we call that off balance sheet financing. Why is that important? Because the more debt you have, the more likely that you are not going to be able to borrow additional money when the need arises. So those are some of the advantages of leasing. Moving along, let's take a look at the conceptual nature of a lease. Here we said that we capitalize the lease that transfers substantially all of the benefits and risks of property ownership provided the lease is not cancelable. Now, what does this mean? At this point in time, it is in order for me to let you know that we have two types of lease. Two types of lease. And the two types of lease are, number one, operating lease, and number two, capital lease. All right? Now, let's take a look at number two, capital lease. That is a situation whereby a good example of a capital lease would be like the example we illustrated before. A company leases an office space from the landlord. The company is the lessee, the landlord is a lessor. So that is a typical operating lease. So let's take a look at a capital lease. We said that when a lease transfers substantially all of the benefits and risks of property ownership to the lessee, provided the lease is not cancelable, we said that that is a capital lease. Now, what does that mean? Let's take a look at this further. It's a lease that do not transfer substantially all the benefits and risks of ownership are operating lease. What we are simply saying here is, if you engage in a lease arrangement whereby you, the lessee, most of the benefit and the risk of the equipment of whatever you are leasing actually lies on you, then we consider that as a capital lease, as long as the lease is non-cancelable. All right? So substantially, most of all the benefit and the risk of ownership are actually on you, the lessee, and we say that that is a capital lease. This is a classic example of a substance over form. Now, listen to this very carefully. Here's what is happening. A lot of people, or some companies, with the intention of not getting loan or debt, because remember we talked about all the balance sheet financing, they say, well, we are going to lease this $500,000 equipment. By so doing, we are not going to report a liability on our balance sheet. But if you look very closely to the arrangement, it is actually purchasing the equipment under the disguise of a lease. So even though the agreement said this is a lease, but if you examine it very carefully, the lessee is actually indirectly buying the equipment. So we call that a classic example of substance over form. Remember, we talked about this concept in accounting, in intermediate accounting 1, substance over form. What does that mean? Meaning the substance of a transaction, or what a transaction really means, is more important than its form. In other words, you can have a lease agreement, even though the contract says lease agreement, but if you examine the clause very closely, you find out that you are actually buying the equipment, not leasing it. And as such, in accounting, we require you to treat it as a purchase. We are going to talk more about this in a minute. So again, it's a classic example of substance over form. Now, moving along, let's take a look at the criteria and procedure for capitalizing a lease. In other words, if you take a look at the lease contract and you examine a lease contract, the lease is either an operating lease or a capital lease. So let's take a look at the criteria for considering a lease as a capital lease. So here we said if the lessee capitalizes a lease, the lessee records an asset and a liability generally equal to the present value of the rental payment. We are going to talk about that more in a minute. Then number two, it records depreciation of the lease asset and it treats the lease payment as consisting of interest and principal. Now, what does this mean? Listen to this very carefully. What we are saying here is if a company, that is the lessee, leases an equipment from the lessor and it is a capital lease, the lessee have to record the equipment as if it was purchased by recording the asset in his book as an asset and recognizing or recording a liability. So here it says, like we said, this is an example of substance over form. In this situation, what we are saying here is if it walks like a duck and quacks like a duck, then it is a duck. So even though the agreement said this is lease agreement or lease contract, but in actuality you are purchasing the equipment in disguise and it has to be recorded as such. So you have to record the asset and you have to record the related liability. So that's what they mean here. They said if the lessee capitalizes a lease, capitalizing meaning recognizing the lease as an asset, the lessee records an asset and a liability. How do we figure out the amount? We are going to talk about that in a minute. So look at the first bullet here. He said then the lessee has to record depreciation. So you are recording depreciation of an equipment that you lease because the assumption is you actually bought it at the disguise of leasing. Then number two, you have to treat the lease payment as consisting of interest and principal. So the monthly lease payment or quarterly lease payment consists of principal reduction and interest expense portion. So take a look at what we have here. For the lessee, lease equipment is debited, lease liability is credited. For the lessor, lease receivable is debited, equipment is credited, so that the lessor can actually take the equipment off his books. So let's take a look at these four criteria in connection with the capital lease. So we said that for a capital lease, the FASB has identified four criteria, and these four criteria are extremely important, and we are going to talk more about this in the part 2 of the presentation.